So I hope to share some of the Asian background, or just a show of hands. How many of you dealing with Asian pension funds in the past? Great, okay. And how many of you have been to any part of Asia? Great, that's fantastic. Okay, so we know the audience. So today, what I'd like to share, we have about 30 minutes and we'll leave some time, hopefully for some questions. And I'm hoping to cover Asia's from a few perspectives. It's a very packed slides with lots of information and data, so I probably won't go through it. The slides will be available on site after the conference, will be in conference site. But I'm hoping to touch upon, one is what's driving the changes and what we see is going to likely to happen, and some of Asia investor behavior and asset allocations, and talking specifically about China a little bit because this has been one of the focus on the Asian pension funds. And fourth, we talked about strategic partnership because we have seen a lot of, no matter it's Australia or the global pension fund, been working with the Asian pension fund. And I talked a little bit about infrastructure, and finally, some of the Asian style of infrastructure opportunities. So very packed, and I have about 35 slides, so I would just pick and choose, but hopefully some of things will be relevant to the Australian investors over here. So on the big picture, Asia right now is very young on average. I think your workforce in Asia is probably, I would say only 7% of people are over age 65. But things are quickly changing, very similar to what happened to industrial countries and Western developed countries 50 years ago. So we expect Asia within, especially driven by South Korea, China, in all those larger countries, it's actually, we expect that within the next 30 years, 25% people will be over 65. So part of the reason in China, one-child policy, but even with one-child policy, each couple produce 1.2 children. But like countries like South Korea and the regions like Taiwan and Hong Kong, each couple probably only produce less than one children, so one child. So you see the pressure of aging, and then they have very little time to actually react to it. And governments are very worrying about it. And they also don't want to actually repeat what happened in the United States or in Western Europe, where promised a lot of social benefits. So as a result, they start to put in tons and tons of reserve into pension funds. And take the Korea pension fund, for example, the Social Security Fund. It only started about 15 years ago, and now it's $400 billion US. And China they have a lot of, China is a communist country, went through some pension reform, 1997, and start to actually realize they don't have enough money to pay out for it, and they started to actually putting some reserve for it. And as a result, they actually, within the last 10 years, they put up reserve $180 billion for every single Chinese company listed overseas in Hong Kong, in the US. They pull back 10% of the sales of the receipt put into the pension fund. So the assets inflow grow really quickly. It's very similar to the Australian Future Fund. And I think it's, if you look at what's happening so far, so I show this chart in terms of size of assets and also where the development of reform has been, from the timeline perspective. And I also show some bubbles over here, which, in my view, these are the key elements of having a mature pension system. And you will see, Australia's up there. They have all the right components: member choice, DB to DC, increased coverage. And in all the Asian countries here, in the key Asian country, Korea, Taiwan, Hong Kong, China, you see still a lot of blue. They're just starting it. So what we'll see is that all three pillars of pension funds, pension system. The first pillar of government pension fund will get lots of inflow of money, making the Asian pension funds to be one of those investment champions from Asia. Not very sophisticated, they are learning their way, very, very young, but they are looking for partners and they are doing picking up a lot of best practices right now. Second, the corporate pension funds, similar to the superannuations, I think it's in the reform. So one country at a time, we'll see a lot of news, and that will drive a lot of private industry and a lot of the asset management, creating a lot of opportunity for the asset management industry for that. And then the third pillar, in terms of the personal savings, that's where we see that is going to be having a lot of growth, and also in all different kind of forms, because the annuity markets is still very underdeveloped in Asia over there. We also see the bank will actually play a key role in distributing. Very different from the rest of the world, where people just go to the investment houses, buy the products. In Asia, the banking distribution channel play a lot because of the strong relationship between the personal and the banks over there. And just give you a high-level perspective in terms of what will look like in terms of what the asset. In typically OECD countries, if I just measure the total of pension assets, counting all three pillars, relative to the country's GDP, usually about 70–80%. Australia is outstanding, 94%. I think the 1 year is 100-some percentage. And US is about 120%, very developed. In Asia here, I will group into three different levels. Singapore, Malaysia. I'm sorry. This is the one. In Singapore, Malaysia, Japan, with very mature pension system, been accumulating money for the last 30–40 years, it's somewhere about 60–70%. So, but you still go to Singapore, there's a huge leakage issue. They save money, but they didn't use it for retirement. They use it for medical, for other purposes. But nevertheless, the purposed savings is about 60–70%. And then you see the next group, Korea, Hong Kong, Taiwan. They just started about 10–15 years ago. It's at the level of 30%. We see fast accumulation for those countries, and aggressively actually looking for partnership. And then the next one, and then you'll be surprised to see the India and Indonesia and China at the bottom. These are the fastest GDP growth countries in Asia here, and they are just nowhere to be able to provide pensions. So government have to do a lot of things right now, and you can't expect that people save money within the next 10 years overnight. So they're facing a lot of pressures, and then you see a lot of activities around, and there are a lot of innovations around there too. And then those countries, especially, not everybody is on the organized workforce, like working for the company. So a lot of traditional measure doesn't work. So to address those non-organized workforce, people in the farm, people, mom and pop shops everywhere in Hong Kong, you have to deliver pension in very innovative ways, mobile, micro pensions. So we see that actually in there. But even with that, the backbone of those micro or mobile, everything, at the back of it is still very sizable financial institutions actually delivering that. And city is actually quite involved in some of those activities over there. And then these slides, I was just trying to show how the pension fund relative to the domestic market in some countries are very large. You look at Japan. 95%, and it's actually out of the $3.5 trillion US, one fund, the GPIF, is $1.5 trillion US. So you can see the pressure of the investments. It's a big whale in the pond. And gradually, when all the Asian countries have started to actually putting more money into Social Security system, they face the same issues. So they drive their investment behavior. When you have too much money, I mean, the Korean government, my Korean client explained to me, I'm about 1/3 of market capitalization in my, in this one fund, and just for them, it's too risky. So they actually, compared to Australia, compared to US countries, actually a lot of them actually very aggressively investing, looking for investment overseas. They drive the asset allocation. And on the policy choices, I think they actually look to Australia as the model country. In a very, very short time, Australia, in 20 years, successfully built a very, very strong superannuation system. Yes, it's not perfect, but for them, it drives the domestic, financial institutions, and then develop a lot of financial talent. And me personally actually accompany many delegations come to Australia, and we also try to put together the key investors to meet with each other to exchange. And then one of the examples is actually 2 years ago, we did an event in Sydney, and the top 7 pension funds and the top 7 Australian funds were actually get together. And I think this is where Australia has a lot of role to play. Leading the investments in Asia here. Tony Abbott, your prime minister, actually led a delegation of 500 people to China about a few months ago, and huge issues is, top 3 pension-related issue. One is how can Australian superannuations will be able to work with some rising Chinese partners, and how Chinese government can actually provide some more access to it. And second is where Australia can actually, some of your best capability can actually invest into this Asian country. A lot of great examples that you have on the infrastructure, they wonder what other things they can actually bring the expertise into Asia. So I live in Beijing, and I moved from New York to Beijing, and where I see is Australian government, especially the embassies in Beijing, play a huge role in trying to connect the dots. So, and I understood the ASI actually have a delegations over there not too long ago, and I'm hoping the understanding between this and also the finding the mutual opportunity will increase. I have not seen 2 successful examples, but I think there's a lot of efforts. But I'm hoping that the communications between the Asian investors and Australian investors will be actually enhanced by all those efforts. Here, I would talk about asset allocations here quickly. I'm trying to give an example of GPIF. Kate mentioned how the GPIF actually invested heavily in bond, and then they are trying to diversify 20% of a total asset allocation from bond into international equity. So we expect it's going to drive huge activity where Citi is actually doing some studies around the implication of a capital market around that move, and it's going to be discussed in our investor services event in 2015. But I wanted to share with you here, it's probably something very familiar. Australia is leading in alternative investments around here, address the issues of the less bond issuance from Australia compared to the other markets like Canada and the US to be able to do a duration matching, since this is a very long-term investment here. But I will also say that compared to Australian pension funds, to some of those pension funds that they're being viewed as some of better practices, I think there's and then where the Asian pension fund is trying to diversify into. One is that the geographic allocations and the international investment, it's a little bit different. I think some CPP is the Canadian pension fund. It's like a social security fund, and to pay out the social security promise to the Canadian. Of course, it's a defined benefit plan, very different from the superannuation fund here. But they are actually take a very aggressive investment because the Canadians own capital market and also diversifying from the Canada. To actually focus around more investment into the best company in the world, and also, trying to actually taking some leadership and board positions in some of the larger company, the co relations investments, and using that pot of money more wisely. Oh. Okay, sorry. I understand this is really far. So the dark side, the dark color part here, probably, I'm not sure. This is the United States. And then the lighter color over here is Canada. So for CPP, Canada. And then like for Norges, it's the Norwegian pension sovereign wealth fund. This is their domestic in Europe. So I'm trying to compare their home market and the North America. And then on this one, it's Europe, UK, Asia, Japan, and other Australia, investment into Australia. So, CPP is very strong investing in Australia, but not all the other larger pension funds. But the key point here is I think they're really trying to diversify away their home country for the reasons of, if you think about Australia, where the economy is really tied to certain countries and certain resources. So when things go well, China go well, everything goes very well. The underlying company in Australia would do very well. But when things doesn't do well, then it presents a very systematic risk. And then the Asian countries, capital market is actually a lot less developed. So they are trying to diversify away, similar to those very, very, very large funds. And examples over here, so here I show the progression of how their asset allocation is changing into more equities, more bonds, but more equity, less bonds, and more alternative investment, and also comparing the different countries. I would say the two key themes in terms of asset allocation from our Asian neighbors. One is moving away from the domestic-centric mentalities, for both regulation-wise and also in realities. So here, it's a very busy slide, but basically, I'm trying to compare how much is domestic investments versus how much is offshore investment. Domestic investment is the light blue color. Offshore investments is the dark colors. And on the left side, I know it's very small, so hopefully you'll be able to read it on the way back on the web. I show the asset size, and then over here is all the largest pension funds, the MPF, the KWAP in Malaysia, Australian Super, the government pension funds in Taiwan, the GIC, the EPF, Social Security funds over here. So basically, you will see the larger investors, sovereign especially, GIC, KIC, and CIC, 100%, of course, that's a sovereign wealth. But then for some of the larger pension funds, they're actually putting a lot of money into overseas as well. You see the PSPF, almost about 30%. And you see the BLI, it's about 70%. So huge, diversification away. And then, but in general, I think Asia's allocation overseas is actually quite strong. And for them, that's actually problematic because for them, accessing, they are young, they are growing, and don't have a lot of sophistication investment overseas. So they keep allocating assets, following all the big brothers, what they do. And a lot of time, you just, with the herd movement, when you're the last one in, you don't get a very good return. So they are still struggling with some of return issues. But diversification is definitely a very key theme over here. And that's where I think the Australians, no matter the asset management industry or the super funds, can really be very helpful for them. The second theme I will mention is around their allocation into the equity and alternatives. Again, very busy slides, but on the right-hand side is alternatives. I would say they start to invest moving quite successfully from the bond into the equities. But on the alternative side, I think they just started. So what we have seen for all the mandates coming out from Asia for the last few years has been around real estate, has been around infrastructure funds, and they are still learning. I mean, these are the difficult areas for them to learn, both for the government to enable some of domestic infrastructure, facilitating them into the pension funds, as well as for them to actually understand those newer asset classes, how they work. So there's a lot of goodwill intentions trying to work with the best funds in the world, such as Australia. And Australia is quite unique in that sense. If I look at globally, only Canada and Australia being very successful and actually achieving quite high returns in terms of infrastructure development. And through very different route. CPP, the Canadian, all the big funds in Canada do more direct investments around the world. And Australia, both the government and also the fund itself, being able to actually to do through the funds, and also be able to actually government having a great pipeline on the infrastructure, and I think more is to come as far as I heard. So there's a lot of interest around there. And so these are the big picture landscape in terms of investment behavior and outlook. So the next 10 minutes, I will try to just quickly run through the 4 themes. One is accessing China. We'll see the Asian countries actually more comfortable with China. And for Australia, probably a little bit different because you already have so much impact from China. So on the asset allocation side, you do want to diversify. But just but there's quite a few things in terms of how China become more accessible. So I wanted to give a quick headlines around there. So first, China is actually underweight, in terms of weighing. If I look at all the bigger pension funds, they are trying to grow China into 10%. Right now, the China capital market availability is only 2%. So how to access China, through different channels has been a big discussion around there. China equities, I would say there's several ways. Direct way, A-share marketing in China, domestic China, and then you could access it through Hong Kong, H-share and the red chip, which is Chinese company either listing Hong Kong or incorporating in China, listing in Hong Kong, or they are Chinese company incorporated outside of China. And then you have U.S.-listed ADR, which, as you know, the Alibaba, the most successful online company, is going to go through. They are doing a roadshow right now. It's going to have, one of the largest IPO in the world. And so from China, so here I show some numbers around how the allocation of shares. So the China A-share direct access about 64%, and through other markets where some people feel there's better governance of the investment environment, there are other ways to access it. And also show some sector weighting. So too much information, but hopefully that will be useful. And then also on the fixed income market has been very, very popular because strong RMB and also because very high interest rate environment. It's very similar to Australia. And over there, again, you have onshore access is representing 95%. So that's why a lot of people try to do a QFII investments, because although you can actually get equity exposures through the external markets, but to get this very attractive, the government bonds or company bonds or state-owned enterprises bonds where backed by the government, majority of access is through onshore, 95%. And there are some availability called dim sum bond, 1%. And then there are some U.S. bonds. And then I think we're going to see more and more Chinese companies, especially the banks and institutions, financial institutions, actually going to make them available in offshore markets. People access through ETF. So you watch out for. You can physically hold the ETF, or you can go through the synthetic approach. And when you do synthetic, of course, through the total return swap, it actually has a lot to do with the QFII quota. So your partner, your counterparty risk is something that you watch out for. And I will spend a minute talking about this latest headline news. Shanghai Hong Kong Stock Connect. This is something is going to, we heard the latest, it's going to be October 20th. So what it means is you actually can buy onshore equities, the China onshore equity A shares from Hong Kong. So you have a registration with Hong Kong stock market, and you can trade Chinese stock, but through the Hong Kong. And then similarly, the China investor can buy Hong Kong shares from China. So it basically is a Stock Connect program, and they open it by stage. So the quota they gave is the total sum of the QFII quota. So the quota on an annual basis is very, very large. So the Chinese government is really trying to address the issue of the access issue, and then having the investors to be able to access China more easily. And they understood the value of the long-term investor and the institutional investor professionalism. And but not every stock is available. So here I share a lot of details of what stock's available and then what the mechanism. But one thing to watch out for, because it's on quota, they have not only have an annual quota, but they also have a daily quota about how much shares can be actually can be traded in a day, both Shanghai and Hong Kong. And if turns out to be more popular, then so it will be more like you submit a ticket, but you don't know are you able to buy the stock until the end of the day. Also, you cannot sell in the intraday. So this is where your provider is going to be very, very important. Because if you use a global custodian, you have a local custodian in Hong Kong, you have different FX partners, and you have different brokers. The whole the whole thing, to make sure it happens during the 1 hour is actually timing-wise very, very tight. So, so something to actually talk to your broker and the custodian about, if you have interest in that. And we can talk about this for a very long time, so happy to talk to you during the lunch hour. And there's some rumors about also another stock market in China. Shenzhen is going to have another Shenzhen Hong Kong stock. I would just say so far it's a rumor. I think they have to make sure the Shanghai one is successful, up and running, and no glitches before they will address the other market. And then a second theme I want to talk about is about the internal management. Investment management. The Asian side, when the fund growing too big of a size, you have to bring the investment in-house. Just difficult to go through your asset manager to seek that alpha. So where we see in Asia, because they grow so fast, so they are all developing a lot of internal asset management capability in-house. So with that, the things cannot be built overnight, especially government pension funds, very similar to, I think a lot of times they are constrained by who they can hire, bring into the funds and the staff. A lot of times they have to actually hire government employees to actually having the positions. So not every single fund are freely to hire financial talents from the market. So, what the implication is they have to rely on a lot of strategic partnership from the financial market. So we see that not only in the US, where you see the Financial Times talking about, financial news talk about the Texas teachers form a strategic partnership. I will show you over here. They buy Bridgewater. KKR is working with teachers' retirement system. And then Chinese company are also trying to access those investment capability, forming the strategic partnership with the strong investor houses. And that's where I see that Australia can be a very strong position for that, working with all those rising Asian talent. So that's one way, is to actually leverage their the financial, the institutions, the asset management capabilities. The way to do it is to streamline their funds. So instead of allocating funds into many underlying providers, they're actually trying to streamline to get a better fee and also have more senior attentions from the funds, and then also taking a stake of the investment houses. And then the other thing that they do is actually go through the custodians. We were selected by the Norges $800 billion fund. One of the key reasons is market access. So when your fund's getting so large and then you are building up your internal investment capabilities, your market access information become very important. And Norges explained to me 80% of the work, 80% custodian work is actually done by the local custodian, direct custodian, the sub-custodian. Only 20% work is being done by the global custodian. So for them, actually leveraging the local direct access is very, very important, because it gave them market information, gave them the government relations, and also gave them a much better pricing as to trying to eliminate the middle name. So this is how the pension funds. So we see. On my work with the Asian pension fund, this has been a very key point for them, is to be able to actually support them on their investment globally. Both on the investment banking space as well as on the public market space to access research and everything. So this is has been a theme of helping them to build internal capabilities. And then over here, I would talk infrastructure very briefly. I have a lot of information around the infrastructure over here. We monitor how pension fund invested, and then Australia has been very, very successful in this area. And then I hear lots of information. Here I won't give it. We kind of write down all the recent deals in Australia as well as the international, what are the investment in. The energy and sectors has been a very key important area. But I think what's key over here is that the biggest infrastructure gap is actually happening in Asia. And there's a lot of, and then in Asia, the bond availability in domestic market is also quite limited, and a lot of time they don't have long-term bond. So this is a natural match for the Asian governments to actually address the infrastructure issue together with the fast-growing pension fund, very similar to what Australia was doing before. Now, so this issue is actually being addressed in G20 in Brisbane. I think November. I think it's involving some task force, and I think there's going to be a lot of leadership actually provided by Australia, by your Treasury. And what I'm expecting is that there are going to be a lot of professional support to help the pension funds to actually be better in investment around here. And then it's going to be a lot of strategic partnership between the pension fund to enable them. And also the government will also trying to address some infrastructure investment issues, trying to make it more professional. And one example I will give is actually in the India case study. India, if you've ever been there, you know how much they need infrastructure. And with the Modi government, they've been actually addressing for it. So here, they did something quite innovative. It's called infrastructure debt funds. So if you invest in India, you'll notice two things have changed recently. One is that they're actually trying to open up the foreign investment profile to actually class different type of pension funds and different investors to make them more available to be able to invest into India. Second, on this IDF, it's quite innovative. So what they're trying to do, traditionally banks is the one who lend the infrastructure money, but then with Basel III, bank cannot do a very risky investments, and also global banks are usually not very, quite limited in taking on the local risk. So especially countries like India. So what has happened is that the Indian government decided to actually separate the infrastructure into two stages. One is the building stage. So from, let's say you're building a bridge, it takes 7 years. They want to make sure that this is where it's supported by the local banks, where they can make assessment on the risk, lending the money to the projects, and this is where the local bank is much better. And then they will structure the first stage up to when the project up and running for a year, have a steady cash flow. And then with that, after the project's up and running cash flow, they want to free up the local bank's money. So they will transfer these projects where, have a stable cash flow and a more long-term investment horizon into pension funds. And they set up something called IDF. IDF could be a strategic partnership, special company vehicle. So it can be a more direct investment or in the form of mutual funds. So more transparent, and then different risk and different price. And so this is something they are building up quite aggressively. They are actually hosting, the Minister of Finance is actually hosting an event in November 17th to introduce. And what they are trying to do, so we've been seeing some leading pension funds is taking advantage of that, the CPP, the PSP, the APG. And they're very interested in talking to Australia. And one thing over here, I would say this is a typical challenges that they see, too long investment horizon. There's always a very unclear tax consideration, what the tax break that can be provided by the government, legal issue and the uncertainties, the political issues that they have, and some currency fluctuations by investing in those emerging market infrastructures. Even return will be high, but there's a lot of issues. And then this is some examples of how Indian government trying to address these issues. So they allow for the offshore products and offshore structures to enhance the governance. They allow to actually create a special tax break. And so they are very active trying to talk to big investors like Australia, superannuations, and all the other pension funds, trying to figure out what can we make you investment more easily. And I see this is a first step of innovations, and then we will see more and more with the G20 effort and with APEC effort, trying to make a lot of the Asian infrastructure to be able to make it more investable and make it more access to provide a higher return to the investor. So here I list out some of the solutions they come up with to address this issue. And my suggestion around here is actually making sure that you have, with Australia, your expertise. I would suggest you leverage, no matter is, us or investment partners to actually to open up and talk with the regulators in emerging country, helping them to actually shape a better performance over there. And we are very happy to be the bridge with a lot of Asian governments, and we are actually working quite a bit. But the key thing here, I think, is to actually looking for the extra alpha. It takes a lot of effort, and I think that this is one area you'll see a lot of strategic partnership will come out.